This is what to do when the stock market is crashing. Some people say, oh, you got to buy in while it's cheap. Other people say, you better sell before it gets worse. I've got the answer on what you actually should do when the stock market is falling and your portfolio is shrinking smaller and smaller. My name is Mark Palmer.
Oh, hi, Mark.
And my mission is to help you build wealth. I'm doing this through avenues like YouTube, Twitter, and Instagram. You can find me on Twitter or Instagram at MarkPWealth, where I'm posting content, educational content that will help you with your own personal finances. I give my experiences and my thoughts on them. Hopefully you're able to take some of that with you and learn from it and apply it to your own life and improve your own finances. Today I'm going to go over 2 things that you should do when the stock market is falling. But first, I want to point out the free $50 referral bonus M1 Finance has going on right now. It expires soon, but if you click the link below this video before it expires and sign up and deposit $100 into an M1 Finance account, you'll get a free $50 to help you out with your investing. One more thing quick, help me help you.
Help me help you.
By liking this video and subscribing to my channel. It helps me create more and more content like this. So if you enjoy this content, please like the video, subscribe to my channel, and I will keep putting it out. Thank you. Oh, and real quick, this is not financial advice, it's financial education. If you want advice specific to your situation, seek out a financial advisor. So, 2 things that you should do when stocks are falling. The first is remember why you started. Think about why you're investing in the first place. If you're investing because you want to make money in the next week or so, you're trying to day trade and time the market, that's not going to work out very well. I'm not going to be able to help you with that. It's highly unpredictable, and the strategies we go over in this video aren't relevant to that. So all I can say, if that's your game plan, is good luck. But if you're investing for the long run, for something like your retirement, or maybe even an early retirement, or for a dream house, or something years down the road, then there are certain strategies you can apply when the market is crashing that should help you out over time. So ask yourself, do you need this money soon? Or why are you actually investing this money? What is the end goal of your investments? And has that end goal changed since when you started? A crashing stock market is a great time to think about these things because your why for investing determines your how for how you should be investing. So ask yourself these questions and determine your why. Think about if you're in this for the long haul, if you're in this to continue building wealth for the long term, or if you're just in this to make a quick buck, because the answer to that determines if you should move on to the second piece of what you should do when the stock market is crashing. So again, if you're only in this for the short run and you want this money in the next few weeks or few months, then don't even move on to this next step. Just good luck, and I hope it works out for you. But if you are in this for the long run and you're trying to build long-term wealth, then the next piece of what you should do when the stock market is crashing is the same thing that you've already been doing. I'm telling you that you don't necessarily need to change a thing when the stock market is crashing. So why I say that is some people say you should buy because everything is cheaper. Some people say you should sell because it's going to keep crashing. Well, you can't time the market. And when we're looking at long-term wealth building, timing the market has historically been a terrible idea because you don't know when it's going to all of a sudden reverse and start going the other direction again. And if you were to sell and sell at the very low and then it just starts climbing again, you're going to have a very tough time buying in at the right time because you'll think, oh, I'm losing money no matter when I buy in at this point. And if it just keeps climbing, you're going to lose more and more. And you may think, oh, I should keep trying to time it and wait for it to go back down again. And you might never get back in. So it's a dangerous game to play. And it could also, if you're timing it and you're trying to buy the dip, as people say, well, it might just keep dipping. So you don't want to throw all your money, your emergency savings and everything just because stocks look cheap. If it keeps dipping and dipping and dipping, and you're not able to live your normal life because you put all your money into the stock market and bought the dip, then you're going to have troubles that way too. So the best thing to do when the stock market is crashing is to keep doing what you've been doing as long as you do have that long-term mindset. One of my favorite investing sayings is time in the market is more important than timing the market. And what that means is The amount of time that you keep your dollars in the market, and however many dollars, as many as possible in the market, is much greater of an impact than you trying to time the market and trying to buy at the perfect time or sell at the perfect time. After working in financial services for several years, I've seen a lot of people get burned by trying to time the market. The market will start to crash and they will sell everything and just hold cash because they're waiting for it to continue to crash so that they can buy in at the bottom. But they sell and then it either turns around right away or it turns around shortly after, and they never are able to catch back up because they sold towards the bottom and they thought they were being smart, but it ended up just rallying way higher and they missed out on a lot of gains. And on the flip side, I've seen the stock market crash pretty hard for a few weeks and then someone go all in with all their extra cash, buy as much as they can, and then it ended up crashing for many, many more weeks and they were just broke. They couldn't live their normal life and they had no cash, and they ended up not even getting as good of a deal as they could have if they were to just keep dollar cost averaging, doing what they were doing before, buying periodically in normal increments as opposed to going all in at one specific time. So the caveat to this part of the equation is I don't know what you've been doing, so me to say just keep doing what you've been doing isn't necessarily always going to be the best thing to do, because maybe you were trying to time the market and that's probably not the smartest thing as far as the way I look at long-term investing. But if you are someone who has been buying periodically, maybe you buy every time you get a paycheck, or maybe you buy once a month into the stock market, when the market's crashing, that sometimes is a good thing in those situations, because now you're getting a good deal when you make those purchases into the market, and whether it goes up or down from there, you wouldn't have to worry as much because you're just going to keep buying. You don't need the money anytime soon, so you buy in whatever price it is that month, and then the next time that month rolls around and it's time to buy again, if it's down again, well, now you got an even better deal. And if it's up, it's like, okay, well, last month's purchases are in the green now. So you can look at it as a win-win when you have that strategy. It takes a lot of stress out of the equation. Personally, I love stock market dips. I also love when the stock market rips higher. It doesn't matter to me because I'm just going to keep buying on the same periodic basis. So I'll tell you about my strategy and exactly how I make my purchases. Every week, I put $50 into my M1 Finance account, and M1 Finance splits it off into all my investments. I love that piece about M1 Finance. So $50 isn't very much, but when you're doing it every week, it does start to build. And no matter what the prices are in the stock market, I'm buying in those fractional shares. I get more when the stock market is lower. I get a little less when the stock market's higher, but all my shares are up then, so that's a good thing either way. And the other cool thing about M1 Finance is I automate this process. So I deposit $50 automatically. M1 pulls it from my bank account no matter what I'm doing. I could be sleeping and it'll do it for me every Friday. And then it automatically invests the money as well. So I don't have to do anything. It puts my wealth building on autopilot. I love that piece about them. So if you're interested in something like that, don't forget about the good referral deal they have going on right now. Get in on that before it expires and get your free $50. Also, if I do have some extra cash, let's say that I got a big tax return or maybe a nice gift and I want to use some of that towards my investments, I will buy it. And if the stock market's down, if it's dipping, then that is a time where I'm buying the dip. And it's different than what I'm normally doing. But even if the stock market was going up, when I decide that I have extra cash that I should be investing, I usually don't care about if it's up or down currently, because that's the best time for me to buy it so I can use those dollars for as long as possible, so I can have more time in the market as opposed to trying to time the market. I just invest it right when I decide that I have extra cash to invest, and it's not something that I sweat whether the market's up or down at that time, because it's out of my control and we don't know what's going to happen tomorrow. So why not get in today? Because tomorrow it might start ripping higher for the next 10 years. Who knows? Probably not likely, but it historically has happened in the past. And historically, if you zoom out, there hasn't been really a 20-year period where the S&P 500 ended up down over that 20-year span. So if you zoom out, long-term thinking, your wealth should go up based on historical trends Obviously, that could change though. There's no guarantees. Maybe tomorrow we find out that a meteor is coming to hit Earth and the stock market goes to zero. Obviously, you'll have bigger problems at that point, but just saying, historically, things have worked out for long-term investors. Not advice in any way though, because like I said, you never know what's going to happen. Even if a meteor is not coming, maybe some big event happens and the stock market will crash and you'll lose all your money. But if that does happen, there's probably bigger issues out there for you to worry about. I'll be worrying about those bigger issues as well. I make these investment moves in addition to my automated moves with my work, such as my 401k, paycheck getting taken out, and then I also have automated investments into a Roth IRA. I have an employee stock purchase plan, so a lot of my investing is automated. I just keep all that while the stock market's crashing. I keep doing the same thing. I'm getting discounted prices when the stock market's crashing, so I embrace it. It's not an issue to me, but I understand for some people it is emotional. They don't want to see their money going down as they're investing it, but you have to remember that you can look at it as two sides of the coin. One side, your money's going down. The other, if you continue to make purchases, you're getting it at a discount. You're buying more shares for that same amount of money that you were investing before. All right, that's enough rambling for me. Let's recap quickly what we went over in this video. The two things to do when the stock market is crashing is one, remember why you started. And if that goal was to build long-term wealth, then move on to step two, and that is to keep doing what you're doing. As long as you're dollar cost averaging or adding into the market periodically, you shouldn't worry about the daily ups and downs when you're more worried about the long-term trend of the market. There's going to be downs, there's going to be ups. Daily charts are going to be very zigzaggy, but in the long term, you just want to focus on zooming out the yearly charts, the decade charts, see an upward trend, and then you should be happy. So when the stock market's down, be happy that you're buying at a discount. When it's up, be happy that your money's growing. Any questions, comments, or concerns, please leave them in the comments below, or you can reach out to me on Twitter or Instagram at MarkPWealth. Thank you very much for watching this video. If you enjoyed this content, like the video, subscribe to my channel, and we'll see you next time.